Hi Nicole, how are you?
Pretty good. I just finished some work, so I finally get to relax. How about you?
Same here. Trying to balance things out. Thought I will check in. It's been a while.
Yeah, true. It feels like forever.
Oh, and recently I've been doing something new. It's called derivatives.
Derivative. So that sounds like very finance thing. So what is it actually?
Don't worry about that. It's not as scary as it sounds. I can explain about it. I'm gonna share something.
Okay, I'm listening.
You can see.
Yes.
So I'm going to start with something simple. So what exactly is a derivative? So it's a financial instrument whose value is derived from the value of an underlying asset. So it's like a shadow as for the asset movement.
Oh, so it's like value depends on other things. That makes sense.
Exactly. And the underlying asset can be anything like stocks, bonds, gold, or interest rate, even weather indices.
Wait, so weather also can be assets?
Yep, because some companies need to hedge the weather risk. Pretty cool, right?
So that's actually interesting.
So I'm going to move on with how derivatives are traded. So there are two markets. One will be the exchange traded market, which everything is standardized, and one will be the over-the-counter market, where more flexible and where banks and big companies deal directly.
So one is like very formal and standardized, and the others one's like you call me and call you types.
Yeah, something like that. So I'm going to move on. So how derivatives are used? So why bother them? It boils down to a few major reasons, which is the first one will be to hedge the risk and speculating or doing arbitrage.
So hedging is like protecting yourself, right? I remember heard from somewhere.
Yeah, exactly. Hedgers want to reduce the risk. Speculators take risk to make the money, while arbitrageurs lock in profits by taking advantage of the price differences. And also changing the nature of a liability and investment without incurring the cost of selling one portfolio and buying another one. So I'm going to move on. So in short, the types of traders will be hedger is cautious one and the speculator is the risk takers, while arbitrageurs will be the profit hunters.
So I like how you explain until I can imagine the personality of each traders.
So we'll move on. The first will be the forward contract. It is a private agreement between two parties to buy or sell something at a future date for a price they agree on today.
So it's like you promise me now, next time you give me very flexible.
Yeah, flexible because it is in the OTC market as it is customized and different people get different prices.
Oh, okay.
So I will move on. Well, futures are similar to forwards but more structured. So they are traded on the exchange and everything is standardized, which is under the quantity, delivery date, and also the price, etc.
So it's like forwards but more behave.
Yeah, and because of the exchange, the credit risk is lower compared to the forwards.
Oh, sounds safer than forwards.
So I'm gonna move on to the options and warrants. Options and warrants are different because they give you a right and not an obligation.
Oh, so I can choose whether I want to use the contract or not?
Yeah, with options, we can buy the right call by buying like call or sell and put at a certain price before a certain date.
So if the price is not good, I just don't do anything, right?
Correct. You only lose the premium you paid.
Okay, that's one I like. Less stress.
And warrants are similar. It's something like it's similar to options, but warrants is usually practiced in Malaysia.
Oh, that part I didn't know.
So the potential ethical dilemmas that investor might encounter. First will be the insider trading, which involves using non-public information for personal gain, which is illegal and unfair. For example, buying stocks
before major news is released. Next will be the conflict of interest. This happens when personal benefit clashes with client or company interest, such as recommending investment that benefit the advisor more than the client. The third will be the dilemma relates to ESG issues. Investors may struggle between choosing profitable companies and those that act responsibly. For instance, like investing in fossil fuel companies may yield returns but raises environmental concerns. And then last will be the misrepresentation of fraud. Occurs when information is exaggerated or risks are hidden from clients, which can lead to significant financial harm. Overall, these four challenges, insider trading, conflict of interest, ESG issues, and misrepresentation, remind us why ethical decision making is essential in investment practices. So,
That's the four main derivative of contracts. Does everything make sense?
Yes, now I really get it, especially the difference between the obligations and in futures and forwards and the right in the option and warrants. It's very clear.
Okay, it helped. So if you ever want to learn more, just let me know.
Sure. Thanks for make me the mini finance lesson, Wei Yan.
Bye.